Welcome to this market and economic update. In this video, we'll discuss two major forces that have been shaping markets recently: the conflict in the Middle East and its effect on energy prices, and the ongoing evolution of U.S. tariff policy. These seem like two very different topics, but they share something important in common. Both are macroeconomic events that affect the broader economy and consumer prices. The good news, however, is that markets have continued to push to new all-time highs despite these challenges. Over the next few minutes, we'll break down each of these topics and explain what they mean for your portfolio. First, let's talk about energy prices. If you filled up your car recently, you've likely noticed that prices have climbed significantly. The national average for regular unleaded gasoline has risen to about $4.50 per gallon, well above the long-term average, and about $1.50 higher than before the war in Iran started. In some parts of the country, prices are already above $6 per gallon. This has pushed headline inflation higher, which complicates the broader economic picture. For some, this may bring back memories of the 1970s oil embargo, when supply shocks led to skyrocketing inflation and gasoline rationing. However, the world has changed considerably since then. The U.S. is now the largest energy producer in the world, pumping more than 13 million barrels of oil per day. This has reduced how sensitive our economy is to global oil disruptions. Another important development is the recent decision by the United Arab Emirates to exit OPEC. For decades, OPEC played a central role in setting global oil prices. But at its peak in the 1970s, OPEC accounted for at least half of the world's oil supply. Today, that figure is closer to one-third. The cartel simply is not as dominant as it once was, and individual member countries are increasingly pursuing their own national energy strategies. The bottom line here is that while geopolitical events can still cause oil price spikes, they likely would have been more severe in the past. While that's no help to those affected by higher gasoline prices, it does explain why markets have not reacted more dramatically. Next, let's turn to tariff policy, which has continued to evolve. Earlier this year, the Supreme Court ruled that the tariffs implemented last April under a specific law known as IEEPA were unlawful. The administration then shifted those tariffs to a different legal authority, known as Section 122 of the Trade Act of 1974. Very recently, a trade court ruled that those tariffs are unlawful as well. On the one hand, tariffs will not be going away. The administration has other avenues they can pursue, and they have already begun trade investigations into many countries. On the other hand, the refund process for previously collected tariffs is now underway. Some importers have already begun receiving payments, and estimates suggest that total refunds could reach between $160 and $170 billion. It's worth noting that from a purely economic standpoint, this represents funds that were taken away and now simply given back. So it's not a true gain for importers. Still, refunds are a positive development for businesses and consumers, particularly after the broader economy held up well in the wake of the initial tariffs. So, while the legal landscape is shifting, trade policy could continue to affect the economy. Finally, the key to these types of macroeconomic and global events is that their impact on markets tend to fade over time. This is why, despite all of this uncertainty, the stock market has continued to reach new all-time highs. In fact, markets have achieved more than a dozen new record highs this year alone. As this chart illustrates, new all-time highs are actually a normal and healthy feature of bull markets. They don't happen in a straight line, and there is always a steady stream of headlines that can make investors nervous. But what ultimately drives markets over time is corporate earnings and economic growth, both of which have remained healthy. We hope you found these insights helpful. If you would like to discuss how these topics affect your portfolio in more detail, please don't hesitate to reach out. We look forward to speaking with you.